As earnings season kicks off today to a mostly upbeat start, J.P. Morgan, the banks, obviously J&J, BlackRock beating estimates. The street had been expecting the worst third-quarter earnings season in 3 years, with industrial companies seen as the biggest casualty as a result of the trade war. Stifel's head of institutional equity strategy, Bannister, joins us this morning, and BNY Mellon's director of investment strategy, Jeff Mortimer. Guys, good morning. Good to see you both.
Morning.
Morning, Carl.
Barry, I want to get right to one of your more interesting calls. You've been net cautious all year long, but you've got a nice tactical call on cyclical stocks going into the end of the year. What is it?
Yeah, we think the market's really ripe for blocking and tackling. Of course, it's going to pivot on the whole question of a recession in 2020. But the setup reminds me a little bit in October 2019 of July of 2016. We had very weak nominal growth in the economy on a year-over-year basis then and now. Things pivoted up a little bit for the next 3 to 6 months after that. So we had been, as you said, very positive for the last year on defensives like utilities, REITs, and staples. But we think it's time for a little bit of cyclical, some energy, some financials, and some industrials into year end.
Does that extend to things like transports or not?
The transports are obviously leveraged to global growth and trade volumes in particular. Pricing is an issue. There are some special situations on shipping related to bunker fuel and so forth. But overall, I think that the market is already starting to look into early 2020, and we're trying to stay about 3 to 6 months ahead of the current situation. And I like what I'm seeing, but we'll be very aware of the risks, and we'll watch that position.
All right. Jeff, people trying to draw analogs to the environment we were in about a year ago. Is this December going to be like last December? Others argue the Fed's in a much different place, even though some of the trade dynamics are similar. What do you expect going into actually the prints we're getting on Q3 and then guidance for Q4?
Yeah, I don't think that this Q4 will be like last year's. I think you had a perfect storm of forced selling by hedge funds and mutual funds. You had a lot of tax loss harvesting as markets turned from positive to negative, and you had algorithmic trading exacerbating some of those issues. So I get asked that a lot by clients. Is this the same setup? And I think, Carl, you hit the nail on the head. The Fed has changed its posture, certainly pivoting to neutrality late last year and then even to easing this year, as we all know. So I think we're in a different backdrop, and we've got more in the tank, almost a 20% gain on most assets. So I don't think Q4 is setting up to be weak like last year's was. Certainly a fear of most clients, but we don't see it at this juncture.
Well, Jeff, what does that mean? Does it mean we can just expect kind of a normal seasonal lift, or do you think that there's more to it than that?
Yeah, I think, again, you're going to enter a decent seasonality backdrop. A lot of markets make their bottoms in September and October. I think if we can get through this earnings season, and I think analysts have, for the most part, as they typically do, they're probably a bit pessimistic going into this earnings print, down 4% or so. And so they tend to set the hurdle a bit too low that companies then jump over. We're seeing a little bit of that today from some very strong reports so far. I know we're only going to have 7% companies, S&P companies this week. But I think so far so good, and I think you might have a decent end to this year. Certainly there are backdrops of trade and tariffs and other issues, impeachment, and all these things that go on that are very tough to map and model. But I think in general, we're in a pretty decent spot as far as markets and rates are concerned.
Yeah. Speaking of being cautious, Barry, this BAML survey this morning, everybody's hiding in cash, REITs, real estate, staples. A third expect the global economy to weaken in the next 12 months. You got this IMF outlook this morning. Do you think we're going to be caught off guard per your cyclical trade on the markets in general?
Well, I think that survey reflects why the defensives have done so well in the last year and year to date. Remember, we have to risk adjust for volatility, the returns at the sector level. And so far this year, utilities, REITs, and staples have clobbered the rest of the market risk adjusted. I like the tone that's going on in trade. I think that both sides are talking with mutual respect. They'll probably throw some bones to each other, and we might get some positive moves there. It's going to be a long slog in terms of negotiations, but I think that the tone is better. Brexit tone is a lot better. And as BMO mentioned, there's been a huge reversal in the last year in the Fed's posture. This injection of reserves is a big, big positive for the market in terms of liquidity improvement.